It is almost 11 a.m. in Hong Kong and Shanghai. Welcome to Bloomberg Markets Asia. I'm Haslinda Amin. Here are the top stories. Asia's major technology stocks shrug off Meta's weak revenue forecast and higher spending estimate. SenseTime leading gains for a second day. The yen extending declines after weakening beyond 155 per dollar for the first time in more than 3 decades, heightening the chances of intervention. Also ahead, Secretary of State Antony Blinken is in China on a mission to press thorny issues, including Beijing's support for Russia and industrial overcapacity. Plus, in India, Reliance taking the fight to Netflix, Sony and Amazon offering a streaming service with Hollywood movies for just 30 cents a month. Now, let's do a check-in on how markets are faring with Avril Hong in the Lion City. Avril.
Yeah, Has, we're actually seeing a pretty mixed picture today. I mean, we heard from Tesla a day ago, and we always knew this was going to be a big week for earnings. Those plans coming through from the EV maker helped to reinvigorate the markets. But today, we're seeing how Meta's outlook disappointed, and it's dragging markets into negative territory. You can see that around the South Korean, the Japanese, the Taiwanese stocks. But we have that outlier in Hong Kong, where the Hang Seng, as you know, has been the top performer among the top performers globally this week. And Hang Seng Tech is actually pulling ahead as well. But we're seeing a lot of concern for the Japanese currency. So let's take a closer look at what we're seeing on dollar yen that has breached the 155 level. Flip the board, take a look at how it has gone past. Remember when 152 seemed to be the line in the sand? We've gone way past that now. This is the weakest level we've seen dollar yen since June 1990. And back then, when it breached 155, it was just a matter of a couple of days before it moved past to 160. The finance minister, on his part, speaking in Parliament, saying they're watching forex moves very closely, but they can't say much for now. Why? Because we have that BOJ decision that's due tomorrow. It's not expected to change anything on rates, but given how weak the Japanese currency has been, it might send out some hawkish signals, and some actually see the finance ministry potentially stepping in, intervening post BOJ. Let's flip the board again. I want to take you to what are the key drags on the Asia stock gauge today, because it is those chip makers, and that is SK Hynix, Samsung, TSMC as well. And this is despite SK Hynix really knocking things out of the park with its operating profit and saying that it expects a full recovery given the expanding demand for AI chips. That Meta outlook really casting a shadow on stocks today. Has.
Avril Hong, thank you so much for that. Let's dig deeper into markets. Mark Franklin, Senior Portfolio Manager for Asia Asset Allocation at Manulife Investment Management. Mark, good to have you with us. Let's pick up where Avril left off. She talked about technology. Yes, gangbuster numbers from SK Hynix. No, Meta disappointed. But yet, when you take a look at the movements in tech, lots of nerves out there. What's really driving the tech space?
Good morning, Haz. One thing that we really have to recognise is that with the technology sector, companies periodically go through periods of investment cycles where effectively the impact is that margins come under pressure. And that sometimes unnerves investors. But if the company in question is able to construct a narrative on why that investment is necessary and have visibility on what kind of revenue growth and a future revenue path that can deliver, then you can assuage those concerns. And I think that the reaction that we've seen overnight has been investors not quite confident enough around the storytelling and the narrative as to why this significant investment upgrade guidance is necessary and what kind of benefits it will deliver. And that will therefore have implications on other businesses that are in a similar situation in terms of their investment cycle and the kind of business opportunities that they're identifying.
Mark, do you have to draw a distinction between tech in the U.S., like the Mag 7, and, the Chinese tech, perhaps? We're seeing an outperformance. HS Tech, in particular, has been going gangbusters, perhaps on the promise of recovery, on the promise of gaming instead of AI. Should you be drawing a distinction between the two?
First of all, there's a distinction in terms of the business models that are prevalent within the US equity tech sector and the Asian equity tech sector. And then the second distinction to draw is the level of sentiment and optimism and investor positioning that is experiencing going into the results season. So in the case of the communications companies that have been reporting most recently in the US, investors were somewhat confident and quite heavily positioned in these names. So the bar for beating expectations was quite high. And if you come back to this region, a number of the Chinese technology companies, whether it's e-commerce, whether it's some of the gaming companies and so on, valuation multiples, investor positioning and sentiment is much more subdued. And therefore, the risk-reward, the asymmetry of the reaction potential is a very, very different situation.
So risk-reward subdued in this part of the world, enough for you to be considering picking up some of those shares?
Well, the way that we approach investing is we look at the macroeconomic, the fundamental, the sentiment and the technical pillars at Manulife. And so we've identified that from a fundamental perspective, valuations are pretty much low these days, particularly in Asia technology. But the earnings growth cycle is subdued. It's partly driven by regulatory uncertainty, but also just anemic nominal growth in the local economies. And so it's a fairly balanced picture. There is an acknowledgement that there is a valuation opportunity, but we're also struggling to identify with a high degree of conviction what the catalysts are.
And in terms of correlation, Mark, tech and dollar and yield and Fed path, how are you looking at that?
So we're seeing a stronger dollar because rate differentials and rate pricing has favoured US assets over other assets significantly year to date. We've seen the number of rate cuts priced in by markets for the US go from 7 to about 1.5 to 2 now. That's led to some upward pressure on the dollar. And the other reason as well is that the US economic data, both sentiment, soft data and hard data, has come in somewhat with a positive surprise year to date. So a relatively resilient growth picture compared to other regions has meant that there's been a flow of capital into dollar and dollar assets. So how that correlates is, in general, you would say that with higher yields, higher rates, long duration assets, whether that's equities that typically have most of their value in the terminal value, may see some pressure on their share prices as a result of the cost of capital, the discount rate rising. But in general, one thing that sort of muddies the waters there is that a lot of these businesses with long duration have very strong balance sheets. In some cases, they're in a net cash position. So they're not borrowers, they're actually lenders. And so their sensitivity fundamentally to rising rates is much lower than it would have been in previous cycles. So it's a mixed bag in terms of the direct correlation between higher rates and those factors within equity markets that are rotating in terms of leadership.
Right. A lot of people talk about how those higher yields will also impact appetite for stocks. We're seeing 10-year yields at 4.65, and people are asking when it will get to 5. There is conviction it will get there. Your thoughts on that?
We focus more on real yields, so the spread between nominal yields and effectively inflation break-evens. And it's also the speed of the move, not just the absolute level. Now, it's fair to say that in the last 6 weeks or so, real yields have clearly risen, albeit not as fast as nominal yields, because inflation break-evens expectations have been rising as well. And so really what we're looking for is real yields as a way to explain the relative tightness of financial conditions and current monetary policy settings. So if we have a steady build higher to a 5% nominal yield on the 10-year, but it's also driven by rising growth and inflation expectations, it need not necessarily have a deleterious impact on equities. But if you have a sudden sharp move higher in nominal yields and it's not driven by rising growth and inflation expectations, that would effectively be a significant tightening of financial conditions. And in that scenario, you would start to see a pickup in volatility in equity markets.
Mark, hang tight. Mark Franklin, Manulife Investment Management, is sticking around. Now let's head over to Beijing as this year's auto show gets underway. It's being held for the first time since 2019, with domestic and global car makers set to unveil new models. Our Chief North Asia correspondent Stephen Angle joins us from the very busy and loud event. Steve, the key themes emerging from this year's show, I know there's a lot of excitement given that 5-year hiatus.
Yeah, I mean, there are so many different themes here to just grab hold of. We're in front of NIO right now, which is, I guess you could call it one of the legacy EV makers in China, because there's, over the last 5 years since we were really last year in earnest for the auto shows, a lot has changed. So many new competitors, and Chinese makers really dominate the EV space here. Of the top 10 cars, the actual models that were sold here, EV models that were sold here in the first quarter, 9 out of those 10 were Chinese brands. The other outlier was Tesla, of course. And again, 8 of the 10 biggest EV sellers here in China are Chinese players. Only Tesla and Volkswagen cracked into the top 10. So that begs the big question: what happens to the foreign legacy players? They have come here in force. The BMWs, the Volkswagens, the Mercedes, the Fords, the Toyota, Chevrolet, and the like, General Motors. They've come in force to kind of see how they can regain some of that gravitas that they had during the internal combustion engine era, if you want to call it that. EVs are definitely dominating the news flow and out on the street here in China in those 5 years since we were really last year covering this auto show. Now, that also talks about the domestic economy, because it's sort of weak right now, and there's a price war that's been launched here in China in March to kind of spur sales, and it's done that. Now, that's also kind of a race to the bottom, because if you look at the top 10 selling models, there are 2 of them which sell for below the $11,000 US. So that begs the question about the third theme, the export situation. How can the legacy automakers in their home markets of Germany, in the United States potentially, and elsewhere compete on the export front, on the import front from China, if they're selling cars at a cheap price? Because, again, of the political situation, Janet Yellen calls this overcapacity, and allegations are out there in the market of potential dumping by the Chinese into these foreign markets. That's why the EU and others have been talking about potential tariffs of upwards of 20% on Chinese EV imports. There's so much to talk about here, and we're not even necessarily talking about the cool new designs that we all come here for, obviously.
That's right, lots of issues there, Steve. You'll be speaking with a guest from the show later this hour. What can we expect?
Yeah, I think we're going to be obviously talking about who's going to win and who's going to be left out in the EV space. Bill Russo is going to be our guest coming up at 11:30. He's a longtime China analyst and well-regarded in this area. Automobility is his company based in Shanghai. We'll be talking about the EV space, and also, if I can have Oscar, my cameraman, just kind of tilt up here. Sorry, Bill, I'm going to take you off the screen there. If we can just see this brand here, it's Hongmeng, which nobody really knows much about, but it is a Huawei-linked car maker. At 11:20, right over here, they're going to be launching some new cars. There's a bit of a buzz forming here because the new era of smart EVs is here, with phone makers and chip makers, tech companies going into the EV space. We already heard from Lei Jun of Xiaomi, really giving us an update on the recently launched SU7, more luxury EV. 75,000 orders already for the Xiaomi SU7, 5,000 deliveries already. Huawei also has its fingers in the EV space. They're not a branded Huawei cars, but they have partnerships with about 4 or thereabout Chinese automakers, and they are very much a part of the EV space here at the auto show.
China displaying its strengths. Our Chief North Asia correspondent Stephen Angle at the Beijing Auto Show. On show for the first time since 2020. Plenty more ahead. Keep it here with us. This is Bloomberg. Welcome back. U.S. Secretary of State Anthony Blinken raised concerns about trade and economic practices in his meeting with the Shanghai Party Secretary earlier today. Our news desk editor Jill Deeses is with us. You know, Jill, quite a different tone compared to Yellen when she visited China. I mean, you got to wonder how Blinken wants to stabilize relations but ramp up trade tensions as well.
Yeah, I mean, I think ultimately, look, they're both sort of two sides of the same coin, pushing on very similar issues. So you had Yellen in Beijing just a few weeks ago talking about industrial overcapacity. That's certainly on Blinken's agenda now as he meets with these top Communist Party officials in Shanghai. He's also meeting in Beijing with some leaders, possibly Xi Jinping. We'll see what ultimately happens. But the other thing on Blinken's agenda is that he's really sort of hitting a lot of China's ties to Russia very hard during this trip. So a lot of that comes down to what China's trading relationship with Russia looks like, how much that may be involved in sort of bolstering Russia's defense capabilities in its war with Ukraine. So ultimately, I think that's all kind of from this foreign policy perspective, from Blinken's point of view, as the top diplomat. I think it's really about driving home that harder message. We'll see how that ultimately plays out during this trip. But I'll remind you, Haz, we're not really expecting a whole lot of major political deliverables really out of this one.
The thing as well is that China is likely to be up in arms, right? We saw how that aid for Taiwan, Ukraine, pretty much linked to TikTok, ban or divest or get banned. I mean, how is China likely to react?
Yeah, I think that one's a really interesting one as well. So obviously, yes, this visit from Blinken coincides with Joe Biden just signing into law this TikTok Act. So they've got 270 days to essentially ByteDance, the Chinese parent company, to either divest the business entirely or it has to cease operations in the United States. Now, so far, we haven't seen a ton of major reaction out of China on this. There are a few things that the government can ultimately do. One, it could, say, have a tit-for-tat response and target U.S. tech companies. The problem there, Haas, is that there's not a whole lot of U.S. tech companies that are really operating widely in China anymore. I mean, LinkedIn pulled out its business just a couple of years ago. Meta, through Facebook, doesn't really have a large presence, so there's sort of limited actions it can do there. The other thing, though, is that if let's say ByteDance does agree to divest TikTok, it is Chinese regulators that would have to sign off on that deal before it could proceed. So there's a lot that's up in the air. TikTok obviously intends to sue, or at least has talked about this potential intention to sue over this new legislation. There's just a lot that's up in the air right now. With
and also lots of ways China can actually hit back, not through tech, but also perhaps the South China Sea. There's also Taiwan. So lots of issues. Jill, thank you so much for that. Bloomberg's Jill Deese is there. Well, let's get back to our guest, Manulife's Mark Franklin. He is still with us. He cites geopolitical tensions deepening and broadening out as one of his key market risks. Yep, we've seen that, and we're likely to see that again, Mark. I mean, how do you play geopolitical risk? Where do you hide?
It's a great question. So first question we have to ask ourselves is, what does that do to the macroeconomic regime? Are we in for a decade ahead of us, which looks very different to the prior decade? And one area that we do think will be a consequence is higher and more volatile inflation than of the previous 10 years. So the second point then is, which kind of asset classes are likely to attract attention and capital, either because they directly benefit from an increasingly uncertain world, or they are commodities or asset classes that actually would show resilience should there be a demand impact. So on the first question about inflation being higher and more volatile, from a fixed income portfolio perspective, we lean more heavily on asset classes such as floating rate notes, treasury inflation-linked bonds. And in terms of asset classes which would show resilience or directly benefit, we think that the commodities and the energy complex is going to serve as a very good diversifier of traditional asset classes in the years to come. We've already seen a very strong start to the year for precious metals and energy and industrial metals commodities. Maybe we go through a period of consolidation here, but generally speaking, the demand drivers and the fundamental reasons why they've performed well year to date are still intact. So it's just a case of a bit of a technical pause, but we would expect these types of asset classes to perform resiliently in the quarters and the years ahead.
Well, Mark, it's also about taking shelter in the dollar, a traditional haven play. We've seen that playing out already, and it's forced the likes of Bank Indonesia to actually intervene to support the currency. I mean, how might this play out, Mark, and which crosses are the best crosses?
Well, Indonesia is a great case in point, isn't it? Because the central banker did a fantastic job of anticipating this cycle of higher inflation. It got nominal rates up healthily so that real rates were comfortably above long-term averages. And yet it's been forced into resuming rate hikes in order to stabilise FX and keep FX volatility under control. One of the reasons why Bank of Indonesia did that is because foreign ownership of the Indonesian sovereign bond market is very high. So it does suffer the risk of capital flight to high-yielding assets, in particular US dollar rates and US dollar yields, in the case where FX volatility comes under pressure and rate differentials widen. On the flip side, those economies and currencies which are running current account surpluses, historically have had low FX volatility, sit on very large FX reserves, should show more resilience in this type of environment. And the Taiwanese dollar would be a case in point there.
Of course, we have to take a look at the yen getting smacked there, 155 and change. But some say perhaps it is not dollar yen you should be looking at. You should be looking at yen yuan. What are your thoughts on that?
It's a great question, Has, because one of the reasons, the unspoken reasons we believe why Yellen visited China recently was not just about industrial policy, overcapacity and flooding export markets. It was also about trying to convince the PBOC not to embark on, or at the very least consider, a devaluation cycle like we saw in 2015. Now, that was quite damaging for the Chinese economy and also the global financial markets at the time. So it wouldn't be an easy decision to take. But the PBOC and Chinese policymakers have expressed behind closed doors extreme concern and dissatisfaction with the weakness of the yen, because ultimately Japan and China in certain verticals are competitors in export markets. So we have to, you rightly to point out, we have to watch the yuan quite carefully. It's been managed within a very, very tight range recently, but all signs point to the fundamentals continuing to see the dollar yen continue to move in the existing direction, which is weaker yen, because the rate differentials are widening. Yen is still seen as a funding source for that carry trade. And the Bank of Japan still has an instinct and preference to run financial conditions easy. So any policy adjustments, either via rate or balance sheet policy, will be incremental at best.
Mark, before we let you go, at the start of the year, we made all sorts of assumptions. They've all been wrong. Are we at an inflection point where you need to rethink your investment strategy? 60-40 may not be the way to go.
Well, 60-40 portfolios have actually performed somewhat well year to date, although a lot of the heavy lifting has been done by equities. What we have to do is consider a slightly different approach in terms of blending different asset classes. So I talked about energies and commodities being a good diversifier. We should also look at sort of alternative assets as well, particularly those that offer diversification and boost the overall Sharpe ratio to cross-asset portfolios. So whether that's private credit, hybrid private public credit, infrastructure, risk premia, trend-type strategies, all of these things blend quite well with traditional asset classes. And then the other point we'd highlight as well is that we are in a world of data dependency by central banks because they lack visibility, and therefore we have to adopt a more nimble approach to our portfolio management.
Mark, thank you so much for your thoughts. Mark Franklin, Manulife Investment Management out of Singapore. Plenty more ahead. Keep it here with us. This is Bloomberg. Well, China hosting its auto show for the first time since 2020. Let's do a check on how those EV shares are doing. Of course, we know that Great Wall Motor earnings beat estimates. Export growth is what it's looking at. We're also looking at BYD currently up more than 2%. Xiaomi is also in focus. It secured 75,700 orders for its SUV7 electric vehicle since last month's launch, paving the way for the Chinese electronics giant to challenge automakers from the likes of Tesla. Coming up, we're back live at the Beijing Auto Show with the CEO of Global Strategy and Investment Advisory, Auto Mobility. This is Bloomberg. Welcome back. China markets just heading to launch a CSI 300 index, eking out some gains, up 0.2%. We know that global emerging market funds have been turning neutral on Chinese stocks, sentiment changing a little. Somewhat. Taking a look where we are in terms of Sense Time in particular, that's one stock that we're keeping an eye on, surging as much as 36%, the most In more than 2 years, it did release its latest version of Sense Nova Gen AI model. The company is blacklisted in the U.S. as we know it. It highlights the intense interest around China's efforts to develop its own Gen AI. CSI 300 in the positive. Shanghai Comp also up 0.1%. We're tracking the yuan, of course, 724.67 versus the USD, pretty flat against the greenback. Let's do a check-in on Japanese assets as they come back from lunch. Avril Hong is in the Lion City. Avril.
Yeah, Has, we're really keeping the focus on the Japanese currency as it weakens past 155 levels on dollar yen we haven't seen since June 1990. Back then, when we saw it hit 155, it was just a matter of a couple of days before it hit 160. It does look like the pace of depreciation in the yen is picking up, but whether it qualifies as rapid moves, which of course the finance ministry has kind of laid out as criteria for stepping in, that is another question. For now, the finance minister has said he cannot comment much on FX, although they are watching Forex moves very closely. Let's flip the board because the reasons for the finance ministry to step in seem to be gaining ground, especially if you look at how the yen is not just weakening against the greenback, it is also losing ground against the Aussie and the euro, and something that we could get intervention post BOJ, just the sheer timing of it all, especially as we wait for PCE numbers out of the US late Friday, Asia time. And then next week, consider how Japan is on a public holiday on Monday. So these are among the things to consider. Let's flip the board again and take a closer look at what we're seeing in the stock markets in Japan. They are feeling the pain from Meta today, that reminder of just how fragile the rally in Japan has been and how it needs to perhaps broaden out to those domestic-oriented stocks. Has.
Avril, thank you. Let's dig deeper into the yen with our MLive executive editor, Mark Cardmore. Mark, we talked about it at 155 and change, down 9% versus the USD this year. Talk of intervention, but you say unlikely, right?
Well, a couple of things. First of all, I remain very staunchly bearish the yen, long-term bear, and I think the yen will continue to weaken this year. However, I don't think it's necessarily going to weaken much more against the dollar. If I had to go from here versus the dollar, yeah, dollar yen might finish the year lower, and I think the risk reward is changing. I think in the very short term, while I don't expect intervention, I don't think it's a high probability risk. The fact is you do have the BOJ, risk of being hawkish, and you do have precedent for post-dovish BOJ having intervention on a Friday afternoon. So I think the risk reward in the short term is not great to be short the yen. I would love it if there's intervention. It would mean there would be better levels to be bearish the yen next week. But I think that for the kind of the last 7 months of this year, or 8 months this year, I think it's going to be more about cross yen going higher rather than being so purely about dollar yen trade.
Mark, isn't it true that it's better to raise rates than intervene in the market? It makes more sense.
100% has. And like from kind of almost every policy sense, it would be logical for the Bank of Japan to hike rates tomorrow. Now, I don't think they will because this is a politically fraught situation. It is very difficult. And you know, we know with the BOJ that if they were likely to move, we probably would have seen a leak to some extent by now, some prepping in the market. So I think the chances of a hike tomorrow are extremely small, and I'm not expecting one. But it would be sensible. And I do think that ultimately we're going to have to see this year the Bank of Japan preparing the market for more hikes. And I think we'll get more hikes. And I think that will slightly change the narrative. This is why the last couple of years it's been a wonderful time to be kind of bearish the yen. I think it's going to become a more difficult trade to be bearish the yen because as the Bank of Japan gets more serious about hiking, there'll be volatility there. But ultimately, this doesn't mean you should be bullish the yen. This is a currency for very valid reasons to be fundamentally bearish. Deeply negative real yields, an economy that's still not growing strong, and an economy that needs to import almost all its commodities in a world where commodities are going higher and higher by the week.
Mark, talk to us about your FX macro scorecard. What are you learning from that?
So this is something that I've been publishing for Bloomberg for the last 10 years. I'm delighted, Has, you're giving me a minute to promote this and talk about it. It does work purely on fundamental factors, but with a momentum overlay. And since late 2021, one of its favorite shorts has been the yen, and it luckily got out of that yen short just before the intervention in 2022, and then got back short again at the end of 2022. It has been resolutely bearish, the yen, and one of its most popular longs in the last couple of years has been long Mex yen, which has been just a wonderful trade. Mex yen has obviously doubled in the last few years, offers massive yield return as well. But I think it's worth pointing, this is a model, it's not got any subjective inputs. And of course, when you run a model, there is intraday volatility, and it was only on Friday last week that Mex yen fell 6% intraday before rebounding. It was only a very brief move, but these can be scary moments when you run these models. But fundamentally, it is saying yen is still a wonderful short, Swiss franc is a wonderful short, Swedish krona is a wonderful short, and it's saying Mexican peso remains one of the best longs in the world from a fundamental basis.
Yeah, and people don't talk about fundamentals enough. MLife Executive Editor Mark Cudmore, thank you so much for that. Now, the Beijing Auto Show is getting underway today, returning for the first time since 2020 with domestic and global manufacturers revving up for new product launches. Our correspondent, Stephen Angle, is there with a guest to discuss China's EV market outlook. Steve, take it away.
Yeah, there's so many themes here. Obviously, we've been away for a few years through the pandemic, and the landscape has changed. EV space has grown so much, and it's dominated by domestic players. And also this year, the theme really is smart EVs. We heard earlier from Lei Jun, the chairman and founder of Xiaomi. They gave an update on their first entrant into the EV space. That's the SU7. 75,000 orders already, 5,000 plus deliveries since that EV was launched in March. A lot of demand to have connectivity in the EV in this market. My next guest knows everything about this. He's the man to talk about it. He's Bill Russo. He is the CEO and founder of Automobility. He's been in China covering the auto market here for 2 decades. You're a Detroit veteran. You know the auto space. How significant is this launch here, or this initiative behind me, where Huawei is really getting its fingers into many Chinese domestic EVs?
Right. I think the key is, if you look at the label, Huawei Intelligent Mobility Alliance, it's an alliance. It's a union of different companies that are using the Huawei OS, the Harmony OS platform, to really present a whole new user experience inside the vehicle. And that's where I tell people who come to China, you have to really get in the car to understand the difference. It is a influenced by technology set of players on the landscape here. The car is becoming a rolling smartphone. It's a part of the Internet of Things, and people expect that software and user interface experience to be present inside the car. And I think that's what you see from Huawei, that's what you see from Xiaomi.
Well, so far they've been a little bit careful, though, internationally, not having the Huawei brand.
Yeah.
The Ito is one with a different builder, and it's number 5 in the sales list in the first quarter. So they're doing something right with their mobility platform, their telematics and their music systems and the like.
Yeah, and when you watch, Huawei's been inside of many different brands already. They're kind of the Trojan horse. You don't even know they're there. They don't want you to know. They don't want it to be so overt that it's Huawei branded on the outside. Part of that is geopolitical, but part of it is also, frankly, they want to sell their OS capabilities to any Chinese. They want to be butter on anybody's bread. If it's smart, come to us and we can put that inside your car. So Huawei's Ito is their own product that's built by a contract manufacturer, and you see the sales of the Ito brand just rocketed up to the one of the top positions in China in just a couple of months.
Premium 6-seater selling for as much as $45,000 US.
Importantly, also an extended range EV and SUV, a family vehicle. People like the flexibility of these extended range EVs.
What about Lei Jun and Xiaomi? How special is that product?
Well, it's also got the feature of being a smart phone, or smart device company, I should say, coming into the car, which in a world like China, where you've got, in Xiaomi's case, more than 500 million Xiaomi ecosystem owners of products, whether it's a television or a rice cooker, you can get a Xiaomi branded something, and you're part of the ecosystem. getting a car that's affordably priced, which is what they've launched, high technology products at an affordable price point, I think they have a built-in addressessable market.
Can the legacy Western automakers still really compete? Look, Volkswagen had a 40-year head start, but they've fallen way back in the table. Obviously, they're in still the top 10 in EVs, number 10. But again, there's only two foreign automakers in the top 10 for EVs. That's
right.
Tesla and Volkswagen.
Right.
What do they need to do? Because is this their last gasp to get any share of this market as China goes almost full EV?
Right. I think the first question is, do people in the EV lane shop for the traditional brands? Does the equity cross over?
Does it?
No. It's very clearly evident in China. Maybe outside of China it's different because you've got multi-generational habits of relationships with those brands. But at least in China, people are shopping for a different kind of product, and the traditional companies just don't make those kinds of products. The way out is, frankly, you've got to figure out a way to bring some of that technology and ecosystem mindset into your company, and you've got to start by doing that here if you hope to stay relevant in the world's biggest market.
Well, you are the former head of Chrysler in the United States, of North America.
In China.
In China, yes, I know. So what are they doing wrong?
Well, what multinationals in general are doing wrong is they're relying on decision-making purely at the headquarters level and not allowing the mindset of what's different about the consumers and the way they shop for technology in the EV age. China didn't invent the EV, but it's created the conditions by which EVs can come into being at a mass scale and redefining the product specification with internet features, right? EVs are tech. It's not just about how you power the wheel.
How much overcapacity is here in the production space in the
It's significant. The market for ICE, gasoline-powered vehicles, shrank by more than 10 million units in the past 6 years. So basically, if you empty the cup by 10 million, you've got at least that, plus whatever they built anticipating growth that never happened. So we're probably looking at 10, maybe 15 to 20 million units of excess capacity for gasoline-powered vehicles, and add on top EV companies. Somebody earlier today, Chang'an, I believe, said there were more than 100 EV startups. Now there's only 17 companies that are operationally producing cars in significant volume. So that says there's a lot of companies that built factories to make products that are not operational today.
What's going to be the result of the price war that's been launched as well in March? Because the economy is slowing here. There's a lot of excess capacity. I mean, these makers are making a ton of cars. There's not enough buyers right now. They're bringing the price down. Some cars in the top 10 list are below $10,000 US.
Right.
Is that the trend, the affordability, or is it going to be cars like that one behind us loaded with tech? Right.
Well, first of all, they were already affordable before the discounting happened. So the discounting happened to make them even more affordable. And what that's doing is it's shrinking the ICE lane even faster.
That's internal combustion engine.
Yeah, the gasoline-powered vehicles converters, the people coming from that lane to shop for the EV because they're affordable relative to the gasoline-powered vehicles. That grows the EV segment. That's the logic of the price war, is more rapidly eat into the other lane. Problem with that is the average selling price goes down. And if you're not building enough volume, you're basically losing more money.
So will there be consolidation here?
Yes, inevitably. As I said, there's over 100 EV startups. There's less than 20 that are viable companies today. So consolidation is happening.
What's it going to do to them as well if EU goes ahead with their dumping tariffs potentially upwards of 20%? I mean, these players are not really in the U.S. The batteries are coming through factories in Mexico, but they haven't really gone into the U.S. There's all kinds of threats of protectionism in the United States. Can they still dominate here in this local market without going abroad, or they still have to go abroad?
Well, they think they need to go global to both legitimize the brand domestically. They can get a foundation here, but going global is where you're going to be able to accelerate your business and really prove yourself as a viable company internationally. BYD already selling very significant volumes outside of China. They're the number one EV producer, first time ever this past month where they surpassed Tesla as an exporter from China.
Yes.
So, yes.
They have 33% of this market, BYD does.
Already. Yeah.
More so than Tesla. Is Tesla in trouble here?
Oh, absolutely. Tesla launched the price war last year because they saw the signs of weakness already on the horizon in China. They're not even here at the auto show. They don't have new products to brag about that are relevant to the Chinese consumer. It's these companies, the disruptors like Xiaomi and Huawei inside of many different brands, that are really the ones to watch right now.
Bill Russo, so good to talk to you.
See you again,
We're going to have a whole show just with you talking about the auto show. Okay. You just heard the themes. I mean, smart EVs and the Chinese export dreams, protectionism. We're covering all the themes right here on Bloomberg TV.
Stephen Angle with Bill Russo, founder and CEO of investment advisory firm Automobility. We thank you both for those insights. We're, of course, counting down to that India Open any moment now. There's still a lot of confidence in this particular market, especially when you take a look at where India VIX is right now, falling to a record low. In fact, it dropped 20% on Tuesday alone, even though we're awaiting results from that 6-week-long national election. Today, though, it is under a little bit of pressure. Sensex index currently down by 0.2%. The benchmarks throughout India also under pressure. The rupee trading at 83.36 versus the USD. The dollar, of course, slightly higher today. Now, one company we're watching is Kotak Mahindra Bank. This is India's 4th largest lender. It's been barred from adding new customers to its digital channels and issuing fresh credit cards. That's after the RBI, the Reserve Bank of India, flagged governance and risk issues with the lender's technology systems. Kotak says it has taken steps to strengthen its IT systems and will continue to work with the RBI to resolve issues. Investors, though, getting spooked by that. Currently, that stock down more than 9%. Well, still ahead, Indian streaming service JioCinema unveils an aggressive pricing plan to take on international rivals like Netflix. We'll discuss its impact on the media landscape next. Keep it here with us. This is Bloomberg. Well, audiences in India can now access Hollywood movies and shows for just a penny a day. Yes, you heard right. And that's part of JioCinema's new promotional plan. The aggressive pricing strategy from the Reliance-controlled streaming service is expected to further intensify competition in a battle for India's more than 1 billion viewers. For more, let's bring in conglomerates and media reporter PR Sanjay in Mumbai. Sanjay, talk about aggressive pricing.
Hi, you're right. This is a kind of a defining moment for JioCinema, the OTT streaming platform owned by Reliance Industries. And they are offering 1.2 cents as low as that for an individual to stream or to get access to the Hollywood shows, that too in their local languages. And there is this is like in Indian rupee terms, it is just 29 rupees for a month. And they are also having another family pack where they can access 4 screens. So the idea, what we had an exclusive chat with JioCinema management. They are saying that the price point is not the peg, but the real thing is that they want to make this habit a daily viewing habit. In other words, they want to get all eyeballs from Netflix, from Sony, from Amazon, from other OTTs towards JioCinema. And they have a hook, a great hook called IPL, Indian Premier League cricket tournament is going on, and they're thinking that at least 500 screens are being accessed. So they want to leverage that kind of cricket tournament, cricket frenzy, and they have now launched this a rupee a day, as low as a rupee a day, for accessing great Hollywood content. So they're expecting to convert all this into a permanent subscriber base for JioCinema. As I said, this is going to be really challenging and defining moment for JioCinema, as it's an OTT player who's competing with Amazon's and the Netflix of that sort.
If cheap is not good enough, you got to go free. That RPL shows. I'm just going to wonder, though, Sanjay, whether it is sustainable. When would JioCinema have to rethink its strategy?
Oh, that's a great question, Haslinda. They reiterated that all live shows, including news and other sports and IPL, would be free. So they think that it is right for an Indian to get access to their great cricket content. And they are telling that this would be free for some time. But what they're trying to do is to get all those cricket viewers to stick towards the platform and to offer them a great content. So, for example, House of Dragon, if they are offering in their own languages, say, for example, in Malayalam or Tamil or Telugu or Kannada or Hindi, they think people would be sticking to Jio Cinema, and they can convert and they can leverage upon the cricket frenzy India.
Sanjay, thank you for that. Our conglomerates and media reporter here, Sanjay in Mumbai. Plenty more ahead. Keep it here with us. This is Bloomberg. And here's a look at Asian tech shares pretty much under pressure after Meta plunge in US after hours, trading on disappointing revenue forecasts and plans to spend billions of dollars more than it previously anticipated in AI development. Bloomberg's Ed Ludlow has more from San Francisco.
Mark Zuckerberg outlined that Meta's put itself in a position to be the leading AI company in the world. And there is a commitment to spend on the infrastructure needed to support that, to build future generations of models on the back of the success of Llama 3. The problem is investors just aren't buying it. And the message that really hit them in the call was that it's going to take time for it to show up meaningfully on the top and bottom line. What we're talking about is Meta AI, the current generation of the assistant. They're trying to scale that. Smart investors, quote, would be able to see that even if revenue is not immediately obvious from AI, you can see their AI products like Meta AI, the assistant, scaling, and you can see the monetizable opportunity. But Meta's business is still mostly advertising. They're seeing impressions growth. They're seeing the average ad price or ad price growth go up as well. And in some cases, you could argue that's where AI is showing its value. Meta's kind of damned if they do and damned if they don't. There have been segments of the market calling for some time, hey, spend more on AI infrastructure, get going on this. And then there are those that want to see the prudence. So that's the message from Zuckerberg. Be patient. Trust us. It's going to cost us billions of dollars to get there, but we will get there. When does this largely advertising-based business see serious top-line growth from AI? Apparently it's coming. Whether investors believe it, well, we'll find out in the markets. This is Ed Ludlow for Bloomberg News in San Francisco.
Well, Zuck's message falling on deaf ears. Tech leading laggards here in Asia on the back of Meta's disappointing outlook, raising those concerns. Asia, as you can see, under pressure as traders add to bets the Fed won't be cutting this year. All eyes on the PCE print this week, of course, and the yen front and center, 155 and change. Investors looking out for intervention. That is it from Bloomberg Markets Asia. Daybreak Middle East and Africa is next. Keep it here with us. This is Bloomberg.